All right, everyone. Super excited to be talking to Geri Kirilova. I hope I pronounced that right.
You
Jerry
nailed it.
Jerry is an investor at Laconia Venture, and coincidentally, actually, also the founder of Venture Co-op, which we'll talk about a little bit later. And just overall good human being, and probably like one of my favorite investor in the VC space. So that's my intro. Jerry, tell us a little bit about yourself, maybe some things I haven't covered already.
Thank you. I appreciate that. No pressure at all for the rest of this interview with that introduction. So thank you. Thanks for having me. Really excited to have this chat. So a little bit of context, I guess I can start from the beginning. And interestingly enough, I actually usually don't share a lot about my personal background. So this is maybe one of the first interviews where there will be some of that. But I was born in Bulgaria, which for those of you who are unfamiliar is a country in Eastern Europe on the Black Sea. If you've ever been to Greece, it's like right next to Greece. Our parents moved us to New York City when I was 2 years old. So I lived in the Bronx for pretty much my entire life. So it was my parents, my sister, and me in New York, and then whole family still in Bulgaria. So a little bit of a classic immigrant story, big focus on academic achievement, not a lot of context on the more political and network-driven aspects of career development and success. So in the absence of a lot of who you know pathways, the default emphasis was on what you know. So said differently, I was a big nerd for the first 20 years of my life.
Did they want you to be a doctor or a lawyer? Because that's usually, people of my background. First choice is doctor, and then
They actually didn't. They gave my sister and me a lot of flexibility in figuring out what we wanted to do. So that wasn't actually a huge emphasis, but it was very much whatever you decide to do, you better do it well. So that was sort of where the bar was set.
How did you end up in venture? Obviously, immigrant, female. I think female representation in venture in general is pretty low. And I think someone with your background, the chances of getting into venture is probably even lower. So tell us about your journey.
Yeah, so I went to NYU for undergrad business school. So I was at NYU Stern, which for those of you who are not familiar, is apparently a huge banking and consulting funnel. I don't think you can make it more than 2 steps onto the campus, which is really just a bunch of buildings in Greenwich Village, without kind of bumping into a recruiter from Goldman or PwC or one of the other sort of more established corporate banking and consulting firms. So, huge emphasis on that. If you weren't really poking your head up, you honestly could go through your entire 4 years there and not know there are any other jobs other than banking and consulting. But I actually ended up there because I knew I wanted to stay in a big city where there's a lot of dynamic things going on. You can work, you can intern, and I basically worked my whole way through college. And I was interested in undergrad business programs because I was always inclined towards small businesses, entrepreneurship, new business creation, and things like that. And so I actually thought like this is where you learn how to run a business. So a little bit of I guess, a happy accident, or at the beginning, an unhappy accident, that I ended up there. And I started looking for ways to get more involved in the entrepreneurial scene. And I actually ended up getting into the venture space when I was studying abroad in Prague. It's a very roundabout way, and just kind of a weird coincidence, because I'm from the Central Eastern European region to begin with, spent my whole life in New York, and then ended up in venture capital close to home. Oh, wow. But not because I'm from there, just kind of roundabout. So I started interning at a fund called Laconia Ventures in Prague. Then I spent a little bit of time at a seed fund in Sofia in Bulgaria called Laconia Ventures. And that was the beginning of it. And, this was back in 2014 when, particularly in Central Eastern Europe, but also on the East Coast in the US, venture capital wasn't really that popular yet. You had some of the classic institutions that are now extremely well known, like USB, FirstMark, et cetera. But it wasn't sort of like a hot thing to recruit for on campus. Everyone who I talked to at school was like, you want to be a venture capitalist? What is that? So on the one hand, the competition wasn't as fierce as it is now. On the other hand, it was much more opaque. So you didn't know about any open roles. There weren't that many funds. So it was tricky. One of the things that was very interesting for me getting into it, particularly in Central and Eastern Europe, is that it was a great entry point for me to start to see areas where I could actually be valuable to founders, even though I was so early in my career. the vast majority of the founders I was meeting at that time were super technical, had been heads down for 2 years building something, had never spoken to a prospective customer, and you would meet with them and their questions would be, so we built this thing. Do you have any ideas on, who we might be able to sell to? And it was just interesting to sort of be able to bring that more business side to those conversations and, effectively get some validation and some encouragement pretty early on that, okay, there actually is a role for me to play here, even though when you look at kind of my resume on paper, it wouldn't automatically think that there's really a logical role in venture for someone with my background.
While you were at, I guess, NYU Stern, by the way, go Stern, also from Stern for my master's.
The master's program sounds more fun, by the way.
They are fun. I mean, I actually get a lot of good exposure. While you were at NYU, did you seek out the venture space, or just kind of, I don't know, the universe kind of naturally led you to that? Like, were you involved with, there's a lot of PE. Well, back when you went, it was probably more PE than VC. Like, were there clubs and stuff you were involved in that kind of give you exposure?
There were a couple of things. One is the Entrepreneurial Exchange Group was a student-run organization that was more focused on, as you can tell, entrepreneurship and startups. There was Tech at NYU, which I was sort of aware of, but not actually that closely involved with. And then the venture capital internship in Prague that I got was actually based on the recommendation of a friend of mine who I had met through a student-run organization called the Undergrad Stern Women in Business Club, USWIB. It's a bit of a mouthful. But that was sort of like the university connection there. It was someone I met through USWIB who said, hey, when I was in Prague last year, I was at this VC firm, you might find it interesting. There was another organization called the Strategic Venture Society, which is basically, it has now become the VC club. I started when I was in my senior year. So for those first kind of 3 years of me finding my way, it didn't exist. Other things that I'll highlight on NYU, though, that were very relevant that I did eventually get involved with are the Entrepreneurial Institute. So there's the Leslie E-Lab, which houses all sorts of programs for student entrepreneurs. They have things like mini accelerator programs, mentor meetings, pitch competitions, pretty much everything you can imagine. So I did actually reach out to NYU's executive director of the Entrepreneurial Institute, Frank Rimolowski, who's just a fantastic person and a truly wonderful resource for the New York City tech ecosystem. Met up with him, had a meeting with him at the E-Lab and was like, Frank, I can't believe I didn't know about this until just now. This is maybe halfway through my junior year. And he goes, well, we didn't open this lab until last year. I'm like, okay, fair. It did not exist for my first 2 years here. But it definitely feels like there's a shift that happened sometime between 2014 and 2018 in terms of the critical mass of entrepreneurial and VC interest at NYU. And so I kind of caught the tail end of that. And it seems like for everyone who's sort of in that ecosystem now, there's a lot of opportunities to get involved.
Yeah, I was having this conversation with a friend of mine recently, even like pre-COVID to now, like post-COVID, because I started investing, angel investing, not too long before COVID, maybe a year and a half. It's just like a night and day that the ecosystem is so much broader. There's just a lot more angel investor, a lot more startups, even during the pandemic, I think.
Yeah.
Like there's a lot of West Coast startups moving into New York. So a lot of people are kind of afraid how it's going to impact New York City. The fabric of New York City has changed so much. And I think tech now plays such a huge role, startup ecosystem in particular, compared to pre-COVID when it was like finance, Madison Avenue, marketing and all of that stuff was playing a bigger role. So yeah, a couple of years.
Yeah, no question.
All right, that's cool. So how did you end up in Laconia? So you're obviously at Eastern Europe. How did you find your way to Laconia? What are you doing today?
Yeah, so roughly at around the same time when I emailed Frank at NYU, I emailed dozens of other people, went to all these events, was looking at things on Eventbrite of like startup panels, things like that. I realized that I had built up a reasonable network in Europe in the venture space because I had spent about a year and then doing some remote work after that for like a year and a half. I knew a fair amount of people there. And then once I got back to New York full time, I was like, well, I guess I have to just do that all over again. So I was doing it in a very kind of grassroots way. And I ended up at an event that was, it turns out it was the birthday celebration for one of Laconia's LPs. Ended up there through an invitation from a friend. And at that event, I met one of the Laconia partners, Jeff Silverman. So very chance kind of meeting, again, sort of tangential in the tech startup world. And then we reconnected a couple months after that. And I started working with him and our third partner, David, on the first fund. So that was sort of the inception story. I mean, it was just me running around for months on end, meeting everyone I could meet. And then I met Jeff.
That's awesome. You got to hustle, right? Create your own luck. So thank you for sharing that. So that brings you to kind of what you're doing today at Laconia. Tell us a little bit about your job at Laconia. Maybe stage you invest in, any vertical you focused on. And then also, tell us a little bit about the Venture Fellowship, which I was actually part of. It's awesome. The way you and Jeff and others are giving back to the ecosystem and the community, and just educate people outside of venture, what venture capital is all about and all of that.
Yeah. So on the fund side, we are now 3 funds in, investing out of our third fund. At Laconia, we are focused on leading pre-seed and seed investments in software companies that are transforming how business is done. So if you wanted to kind of put it in a neat and tidy list of boxes that we sort of have to check: pre-seed, seed, B2B software, geographically focused on the US and Canada. We do have some flexibility beyond that. And we actually just closed our first investment where one of the founders is in the US, the other founders in Mexico. So open to things outside the US and Canada as well, but that's sort of our core focus area. We're sector agnostic within that. So we have everything from fintech to retail tech, e-commerce enablement, digital health, supply chain logistics, all across the board, very opportunistic. And thematically, we're focused on companies that are solving really high pain point problems that are a must-have, not a nice-to-have. And we're really looking at, is this something that is super high pain point? We already have a sense of who the initial customer segment is. We have some sense of market demand, even if there isn't revenue yet. In some cases, there may not even be a product yet. And then all of the more standard VC things like really big market, could be $100 million business, et cetera. So that's the focus on the fund side. I'll pause there in case there's anything you want to dig into a little bit deeper there.
No, that's helpful. I think maybe a couple of years back, when you and I met, you had particular focus in the Northeast. It seems like you broadened now, like you moving to like Mexico.
Yeah.
As well.
Yeah, we have broadened the geographic focus. Part of that, a large part of it is driven just by the way that we've changed the way that we've worked since the pandemic. Yeah. We used to do almost 100% meetings in person. So from that perspective, given just the sheer volume of talent in New York and the Northeast corridor, it didn't make sense for us to, incur all of the logistical constraints of really looking much beyond that. There's plenty of incredible companies to fund in this region. It's just with the pandemic, it became clear that it didn't really matter where anyone was, just because the entire industry changed the way that it does business. So from that perspective now, whether someone's in New York or in North Carolina, they're still in the same place, which is on Zoom. So we've definitely broadened that up a little bit. There's still elements to us that are important, like being able to really build trust with founders and ensure that they know that we're on their side post-investment, that we're able to maintain open lines of communication. And we've become even more deliberate about how we establish those pathways now. But yeah, it really matters less where everyone is located logistically. And I would say over the years, aside from the geographic focus, we've evolved the way we think about some of the investment criteria in terms of, frankly, broadening them. So, we always try to use them as a way to point us toward the highest potential opportunities, but not to box us out of things for arbitrary reasons. So, if anything, I would say we've basically cut down on things like revenue requirements, geographic requirements, et cetera, if we can get comfortable with the core principles of why this investment makes sense and could be a huge a game changer, both for the industry that they're working in, but also for the impact of returns on our fund. We're much more open to things now than we were when we first started out.
Oh, that's great. Actually, that's interesting because historically, like when I got into startup and angel investing and stuff like that, like East Coast venture is always viewed as like numbers driven, right? I think it was like traditional finance guys moving into venture, and they used to look at things similarly, like where are you from revenue and all of that stuff. But I think the mentality has shifted, like it's happening at Laconia as well, which is great, for the ecosystem. So that's awesome.
Yeah, yeah. And a lot of it from our end is still sort of, in a sense, numbers driven, but it's based on different numbers. It's looking at the numbers of success rates across various stages. It's looking at conversion from seed to Series A. It's looking at failure rates. It's looking at, is this business really materially de-risked after some arbitrary metric is met? Like, is that going to have an impact on returns ultimately? And both in the broader data sets and in our specific portfolio data, we've seen that you can have outliers really anywhere up that curve. Some of our biggest winners in the portfolio have been pre-revenue, some even pre-product. So seeing some of those traction points, and again, even seeing it just in the broader data, has been a pretty clear signal that there isn't much to be gained from constricting on those arbitrary criteria.
Yeah, especially I think at the early stages. Ultimately,
exactly, for early stage, for pre-seed seed. Once you're writing Series B checks, whole different game, but yeah.
Ultimately, you're betting on the founder and the team, right? So
and the market, you're betting on, like, is this going to be, is this something that could be really, really big if certain things went well? We do spend a lot of time on the business viability. It's not just, is this person smart, but it's, do we see a path in which this actually makes sense?
Absolutely. Tell us a little bit about the Venture Fellowship, which I was privileged to be part of about a year ago, which I had a great experience in. But yeah, I want to kind of hear from you, like, how did that come about? What was the original idea? Where did it come from? And just where along the journey you were.
Always happy to hear the positive feedback. So thank you. And thanks for asking this question. So we started the Venture Cooperative about a year, actually almost 2 years ago now. And the basic premise of it can be summed up as, there's only 4 of us at Laconia. There's all the stuff that we want to do to help founders, invest in founders, share resources, et cetera. We know that we can't do it all. So what we want to do is help more people, help more startups. And, our long-term bet is that in order for us to be successful as a firm, there needs to be a flourishing ecosystem of early stage startup activity, whether it's angel investors, advisors, employees, founders, et cetera. Like, you need a critical mass of that for this to continue growing. And this is basically our way of supercharging that early stage layer. The inception story of it is, we've been running an internship program for many years. Actually, fun fact, I was one of the original Laconia interns. So really living the dream there in the industry, from intern, associate, principal, managing partner. Quite a trajectory. We were doing this internship program, and I got very frustrated one cycle because we got something like 400 applications. And I went through them and I realized that, at least 250 of these people were pretty remarkable. And I could only hire 2 of them. I just thought it was so ridiculous. I was like, what am I going to do with these other 248 people? We have no engagement mechanism for them. Startups need help. All these people want to do things. And we can't use all of them in this capacity because it's a paid internship program. We pay people. We don't really have that much work, right, within our constraints that we can outsource to other people. And even in the broader ecosystem, there just aren't enough roles for all the people who want to get involved. So we thought, all right, how can we strip the educational element out of this and get people up that learning curve faster so that they can learn everything they would learn if they were working with us? So they get that context. How do we get them up the learning curve faster, and how the landscape works, what the different roles are, what an angel syndicate is, what running a fund is like, how angel investing is different from fund management, what corporate venture capital is, really just a whole landscape view, so that hopefully we now have more people who are independent of us, where we're not a bottleneck, just doing all sorts of things. So that was how we initially thought about it. One of the things we were really careful about was we didn't want this to be one-sided. We didn't want this to be perceived as, us creating an army of people doing free work for us. So the program's entirely free. There are no requirements. Like if you do 2 sessions and you decide it's not for you, we don't make you do anything. You don't have to keep coming. You don't have to talk to us. Like it's totally by choice. They don't do any work for us. If they do happen to come across a company that we end up meeting with, we keep them looped in on all the meetings so that they can get to shadow that investment process. If we do the deal, we give them carry in the fund. And then, over time, we've developed a couple of other new projects that we can work on with people and initiatives. So we're actually doing an announcement around some of these things next week. But we've always, been of the philosophy that if anyone's getting involved with this, they should be getting some benefit out of it. And it should be entirely up to them kind of where they lean in and lean out. So that's a little bit about it. We're launching the 4th cohort soon. If you're interested, check out more on venturecooperative.org.
Great. Thank you for that. Yeah. And just, it's a personal plug, amazing experience, really smart people, and Geri and Jeff, very giving with their time and everything they provide in the program.
Thank you. I appreciate it.
So, aside from the venture fellowship, even before that, I think you're one of those people that are just, giving back to the community and the broader ecosystem. You share a lot of insights on VC landscape, startup landscape. I think you've had now maybe a famous post around just like when to fundraise that kind of went viral. So like if I have a lot of founders in my audience, just overall startup ecosystem folks, you tell us about your thinking there, just like when to fundraise, when not to fundraise. And then also love your kind of perspective on the venture ecosystem in the current state after the 2 years of mania we had, where we are in the cycle. So yeah, all of that. To start with, maybe just, like when should a startup look to fundraise versus maybe bootstrap? Like when does fundraising make sense?
Yeah, it's one of those difficult questions because there are very, in my opinion, clear criteria on when founders should prioritize fundraising. The problem is that there aren't really a lot of alternatives in the interim. So it's very easy to say, right? Like founders should only raise if X, Y, Z. Very few options sort of on the other side of that. So I want to caveat this by saying that I think it's a very difficult ecosystem for entrepreneurs to navigate. There are some options and they're increasing, but they're still not great. And, financing startup businesses remains really, really hard. So I'll start there. From my perspective, when it comes to raising money from venture capital firms in particular, I think sort of a good litmus test for whether it makes sense to raise or not is considering whether capital is the gating factor to growth. So if, I'll invert that to kind of provide a counterpoint to make that point clearer. If you want to raise a bunch of money to test a bunch of things and you don't know if they're going to work, that's usually a bad framing of the raise. On the other hand, if you've already tested a bunch of channels, you've talked with some customers, you've done customer research, you have identified who has this pain point, and you have some of those assumptions in place. And the thing that's gating your growth is that you need capital to pour money into marketing or even develop a product. And the bottleneck, right, based on everything you validated today is capital, then it makes sense to raise. So, in some businesses, this is true right out of the gate. You might need upfront investment in product development to even get off the ground. So there are cases where there's no revenue, there's no MVP. Sometimes, if it's an enterprise grade product, for example, like you just need $3-4 million to get it off the ground. Makes sense, assuming you've demonstrated something else in the market validation side. In other cases, there's a lot that you can do without raising money upfront. You can kind of do a low-tech version of what you're building. You can have service revenue that supports the initial go-to-market. But once you reach the point where capital is the gating factor to growth, I think that's when you really start thinking about raising venture capital.
I loved how you framed it. Like if you're just raising for the sake of raising and test out a bunch of ideas that you don't know it's going to work or not, probably not the right time.
Yeah. Or like even said differently, like, if you have any other alternative that would move your business forward, you probably shouldn't raise money.
Yeah, I think a lot of founders don't realize, when you do raise a lot of money upfront, it like dilutes your stake.
Yeah, it reduces your optionality. It adds more pressure. It raises the bar on where you ultimately need to get to. So the inflection point, or the difference between the trajectory of the company without raising money versus with raising money, there has to be a big gap there to sort of justify the additional expectations, risk, investor management, like peace of mind, et cetera. It's a big commitment. So it has to be clear how raising money is going to materially change the trajectory of the business.
Percent agreed. You tell us about, I guess, the state of venture as we know it today, after the last couple of years of what I call mania, free money, right? Different interest rate environment, obviously, that's having an impact, and just overall venture as a whole.
I think I have a little bit of an unpopular view here, which is that the mania was a little bit of a mirage. Like, if you look at the data in the aggregate, yes, round sizes went through the roof, valuations went through the roof. But if you look at deal counts and you look at distribution of those rounds and you look at averages versus medians, what you'll really see is that all those headline numbers are skewed by a very small number of funds, a very small number of startup companies. And for the vast majority of founders, it wasn't any easier to raise. So I would say for the median founder, nothing is really that different. It's still really hard to raise money, and it's always been really hard to raise money. Of course, when you start to segment the market, if you look at, for example, growth stage companies, Series B and C stage companies that have raised hundreds of millions of dollars before reaching product market fit, that is sort of an edge case, right, in the ecosystem. And it's very different for them now than it was 24 months ago. But particularly for pre-seed and seed, it sort of is, it's not that different from what it's always been. And if you look at, the data over a longer period of time, the trend line is still consistent. There was a spike for a small subset of those companies, but for the most part, everything is still up and to the right, and the opportunities are there. I think implications for a lot of founders who are just now going out to raise, there is less pressure to deploy capital. So firms are broadly going to move more slowly now than they would have over the last 2 or 3 years, because there is a change in sort of, liquidity going into fund managers from LPs. So we're not going to see, 1 to 2 year deployment cycles for funds in the short term. They'll probably go back to 3 to 4 years. Any of those, which again, I insist are sort of still the minority of rounds that got done, but any of those rounds that did get done at $50 million valuations at seed and $200 million valuations at Series A, to some degree, those are going to get scaled back because the entry points no longer make sense relative to the exit expectations now that multiples have come down. So we're expecting more of a reversion to the median there in terms of those valuations. So for founders, I think the principles of getting really organized in terms of building a pipeline of investors well in advance of a raise, preparing all your materials, being able to run a competitive process in a very structured way once you sort of have all those ducks in a row, super important. It's always been important, but I think particularly now, there's more of an impetus for founders to really own and drive the momentum of their fundraise.
Yeah, that's a super interesting take, actually. What you said about the mania. I guess if, thinking about it, there were probably some outliers, that was kind of driving some of that, particularly outlier sector, maybe like Web3, for example, right? But when you say that about the mirage, you're talking with the purview of B2B SaaS, right? Is that kind of your take, or was it just in general?
I don't have a lot of visibility, for example, into Web3. I suppose it's possible that, of all the companies that pitched a Web3 startup, a higher percentage of those got funded over the last 2 or 3 years.
Yeah.
I'd have to look at the data to see. But yeah, my perspective is more specific to early stage B2B software investing, which also has been on a bit of a hot streak, right? It's become more and more popular as a category.
Yeah.
When we first started Laconia in 2015, a lot of the prevailing wisdom was the largest outliers are driven by a consumer. If you don't have the potential of hitting a Facebook in your portfolio, you're going to have worse returns. Now that we're sort of in a post MongoDB, Datadog, Salesforce world, and I guess Salesforce was relevant even back then too. I guess that's less of a concern, but I mean, B2B software is like very fundable right now. And even there, I just think the distribution has been really, really lopsided.
So I think we covered the venture fellowship, state of venture. What else? What else do you want to share with the audience? By the way, really enjoying our chat.
I don't know.
Okay. I mean, if you don't have anything to share, that's okay as well. I think, we covered majority of what we wanted to cover. One thing I guess I would like to get your answer on, it's like I ask everyone who comes on the pod is like, what advice would you give others that are maybe watching that maybe interested in pursuing entrepreneurship or the startup, or maybe even, being in the investor side? Like, what advice would you have for them from your journey, your personal experience?
With the caveat that advice is always very specific to anyone's circumstances and goals, I would say something that kind of just looking back on what has been important for just my like personal career growth and overall personal happiness, having a backup plan that allows you to take real risk is super important. So again, this will be different for everyone depending on their circumstances, but my sister and I often joke about like why our lives are so difficult sometimes, right? It always feels like we're doing really hard things professionally. And it sort of dawned on me that we've had the privilege of kind of skipping a step in the immigrant journey, right? Often you go from survival mode to stability, then you have the luxury of fulfillment. And we've kind of gone from the survival mode straight to the fulfillment. Yeah. And I think a big part of why we've been able to do that, or at least I'll speak for myself, is because barring some sort of major catastrophe, I've always kind of known that like I have backup plans. So one of the things I did when I was in college is I did a lot of private tutoring, and I ended up running a small test prep center. And so when I was figuring out where I kind of wanted to focus full time, I was like, well, if this whole venture thing doesn't work out, like I could always go back to tutoring, make money pretty fast, keep the lights on, figure out the next thing. So whether it's something like that, or it's bartending, or it's just having like savings, or a couch you can crash on, I think just having that buffer and knowing like what's the worst that can happen, right? Knowing that there's some buffer there is really helpful, because then you don't have to settle for sort of the lower risk, more stable thing. So that's the extent to which you can control that. I think having a backup plan and acknowledging it can be really helpful. And then the other thing I would say is, this is similar to the point about it really just depends what your goals are. One of the things that's been both really challenging and really rewarding about my path is that I've always been pretty focused on doing it on my own terms and not sacrificing on certain principles. And in any industry that you're in, but I mean, I can really speak for venture, there are a lot of games that are being played. There's a lot of politics, there's a lot of navigating other people's constraints, egos, etc. And it's been really interesting to see if we're going to be able to do this on our own terms. So I think for anyone who has the luxury, I think it's a fun challenge to see if you can do things your way without compromising on the things that are really important to you. We'll see. The jury's kind of still out. Well, we're still pretty early in this venture game, given time horizons, but I don't know. I would definitely give people the advice of trying to do it that way, because it's very, very interesting.
That's awesome. To your first point about just the backup plan, I read a lot, as you can tell, like just books. Yeah. One of the really interesting story that kind of resonates with that, what you said, was about Arnold Schwarzenegger. When he was starting out in the industry, he was actually he had a sizable real estate portfolio when, he was Arnold, the guy, and Hollywood was not kind of looking for that profile. He didn't have to take, kind of change himself, lose weight and stuff like that to kind of fit whatever Hollywood was looking for. He could live off his real estate investment and then wait for the right opportunity. And then when it came, he kind of created his own category of genre of movies. So 100%.
Yeah, absolutely. Yeah, there's a little bit of a stereotype of, wanting to back people who have no backup plan and have no alternative. that doesn't really resonate with me. You don't want people to be doing something because they're stuck, right? And they have no other option and a double or nothing every step of the way. I think you get the real leverage and the real appetite for risk and the real upside if you do have a reasonable backup plan and you know that you don't have that much to lose by trying to do it right.
100% agree. All right, well, I think that'll conclude our conversation. Thank you so much, Geri. This has been wonderful. And I look
Thanks for having me.
Yeah, I look forward to seeing you in person soon.
Likewise.
All
Really
right, have a nice
appreciate it.
weekend.
You too. Bye.
Bye.